Jim Lacamp, you said you were watching the 28.15 level on the S&P. We're trading exactly at that level right now. Why is it significant?
Because, first of all, in October, November, and December, we stalled at that level. So technicians are going to be looking at this level. What they're going to see, what they're going to look for is a close over that level. We have pushed, a couple of days ago, we pushed through that level, but we could not close above that level. So the longer that level provides resistance, the more meaningful it becomes. Now, today is also, sir, the quadruple witching day. And if you look at what happened to the market after quadruple witching day in September and in December, the market had a meaningful sell-off after both of those days. So that's another pothole, landmine, speed bump that we're looking at. Finally, we're going to have this share buyback blackout period in front of us, and that has provided some challenges for the market the last 2 quarters as well. So in the very short term, we've got some challenges. We've got some things that the market's going to have to deal with. I think where the market gets the catalyst that it wants is when earnings period hits, we should be okay, because we've lowered the bar so far that by the time these earnings come out, we should be seeing a positive market response. History shows that if you raise the bar too much and the quarter comes out, the market doesn't respond very well. But if you lower the bar a lot, then the market responds pretty well once those earnings come out. So I think in the very short term, we've got some challenges. But beyond that, I think the market's going to be okay. Inflation low, interest rates low, and corporations profitable.
I mean, Jim Lowell, we're wrapping up another very strong week for the markets. The tech trade is back, and that appears to be one of the big debates as to whether it can continue, whether earnings expectations have been lowered enough for the market to beat. Do you agree with Jim Lacamp? That's true?
Well, it may or may not be true. We'll see what the earnings tell us. We definitely are core believers in fundamentals driving the market, and earnings a key driver of them. We think the tech sector clearly has room to run, not selectively so, maybe not as a whole basket of every technology name, and not just domestically, but globally as well. We continue to think that it would be a fool's errand to bet against a fully employed U.S. consumer. And our Fed Chair Powell continues to weigh in and effectively assuage concerns about any risk of near-term recession, any risk to our slow growth, not no growth economy outside of event-driven news and their potential impact. So we think this is a time where on market dips, you want to add to your best ideas. You want to bolster your long-term bets as opposed to looking for ways to exit this particular marketplace. And unless and until we see the fundamentals erode, interest rates, earnings, and economic data, we continue to think buying on the dip will make sense.
Hey, Jim Lacamp, a number of issues are going to be with us for longer than maybe some investors thought. Obviously, Brexit is facing more delays. The president himself says we're probably facing a delay in getting some kind of China trade resolution. North Korea also looks to be pushed back. What are the implications for the year, at least, having those overhangs with us for longer than we thought?
Okay, here's the thing. That's a great question. Here's the thing, though. We were in the fall, we were threatening to raise these tariffs from 10% to 25%. Now what we're saying is we're not only not going to raise them to 25%, if we get a deal, they're going to go away. That puts businesses in a position to start making plans, because now they know they're either going to be 10% or they're going to be 0. That's enough information for me to deal with. That's a devil I know versus ones that I don't. So I think the further we go on and the more it looks like we are going to get a deal, the more that business will start re-engineering growth, property, plant, equipment, hiring, all of these things. In terms of the Brexit, you're not really seeing much of a market reaction. We had the no vote. The market didn't react too much. I don't think it's going to be a big driver for American stocks. And the bottom line is we've had so many people, Carl and Sarah, calling for a recession next year. If we get a recession next year, this is going to be the most perfectly predicted and well-advertised recession in the history of the United States. So I don't think we're going to get one. The economy is slowing a bit, but it should start to regain its traction as the concerns about these China trade issues start to ameliorate.
I'm not sure we know for sure, Jim Lacamp, that the tariffs are going to disappear. I mean, some people are still talking about whether some would remain in place so that the U.S. can have leverage over China to make sure they enforce some of these reforms.
Yeah, but 10% to 0 is a lot more information to deal with then 10%, and we might go to 25, and we might put it on every product out there. At least we're setting a cap on it. And the reality is, at 10%, it hasn't disrupted American business as much as the uncertainty has disrupted American business. Remember, back in the fall, a lot of businesses front ran and they pre-ordered things thinking, my gosh, we might go to 10, we might go to 25. And then that front running left a hole. And so we saw the data start to soften after that. Now I think you're smoothing things out. You're either going to have 10% or 0. Again, I think that's enough information for businesses to feel confident that they can start making plans again.
Finally, Jim Lowell, on the data today, seems to be a divergence as far as the U.S. manufacturing sector, and Santoli mentioned this earlier, the U.S. consumer holding on in good shape, record number of job openings, and yet industrial production, New York Fed manufacturing, pretty disappointing. What do you make of that divergence and where it takes us for growth this year?
Month-to-month data is always going to be volatile. We think the manufacturing sector is actually strong, and the numbers bear it out, even though today's number was marginally disappointing. We think the focus ought to be on the driver of our economy, U.S. consumer. Today's JOLTS report, job openings, clearly indicative of a consumer that is very confident in near-term economic conditions, so confident that they're leaving their existing jobs to find a more interesting and or better paying job in droves. We take that as a very bullish indicator on the strength of the driver of our economy, and for that matter, a driver of the global economy as well.